This video is about retirement income planning using the 4% rule and 5 things that really concern me about this extremely popular rule of thumb that investors and soon-to-be retirees are using to plan out their retirement. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about and talk about investing for the past 40 years or so and creating income streams from investments over the past 15, 18 years or so after stumbling into early retirement along with my husband. I'm not trying to sell you wealth management services. I just like investing. I think it's really a great fun activity, and thank you for listening to me talk about it here. All right, so the 4% rule, I've talked about it here before. I get angry comments frequently when I say anything negative about the 4% rule because this is the foundation of retirement planning. So many people have followed this rule, which was, in case you're not familiar with it, developed by a financial advisor named William Bingen. And this was done, he developed this in the early 1990s. And basically it says that if you withdraw 4% a year, and you can adjust it for inflation, which you would need to do to maintain your standard of living, if you do that during retirement, then you should have enough money to live off of your investments with this method. Now, a couple of assumptions here, or not really assumptions, but things that were in place, and that is that this was based on a stock and bond portfolio, and it was also based on someone living about 30 years in retirement. I have 5 major concerns about the 4% rule, and I'm going to share them with you in this video. First, I want to point out one thing, and the name of this video is Retirement Income Planning using the 4% rule. But one thing I hate about the 4% rule is that it's not income. It's spending your money. It's spending that money that you or someone else worked hard to make, and those returns that you've gotten from your investments. So those withdrawals that you make, the 4%, could come from your initial withdrawal, your initial deposits. They could come from income that you've made, or they could come from capital gains that you've had, or compounding. But it's not necessarily income. Sure, some might come from income, especially if you've really focused your portfolio on income. But most investors haven't, and stocks don't deliver a high income. So this is not income. It is taking money from your savings to live and planning, hoping that you don't run out of money in retirement. I'm not trying to induce fear. I'm just saying that there are things about this completely accepted rule of thumb that concern me, and that's what I want to address in this video. The first concern is time frame. The 4% rule was based on a study done based on investment returns from 1926 to 1976. Okay, so I would naturally go, okay, well, that's a pretty nice long study period. I feel comfortable with that, or at least I used to say that. I don't say that so much anymore. And you may be thinking the same thing. Okay, 50 years, wow, that's a really long time. But here's what concerns me about this. The time frame for which you or me, I, say you or I, anyway, for which we will be making retirement withdrawals is different from the time frame that the study was done. Not only that, but it's not going to be 50 years. It's going to be the 10, 20, 30 years that I'm making retirement withdrawals. So it's almost irrelevant that the returns were this from this time frame. It's almost irrelevant what the results showed for that 50-year time frame, because that's going to be different from when we're making retirement withdrawals. And that will determine what's happening during the time frame that we're making retirement withdrawals, will determine the longevity of our retirement account, whether or not we can make those withdrawals. So that's problem number 1, and it's just such a basic, simple premise. I'm really not that smart, but it just is so obvious that we're going to have not 50 years probably in retirement, most of us, And it's going to be a different study period. So we don't know whether or not that will work. And just because it happened to work during that other time period doesn't mean we're going to have those same economic conditions in financial markets going forward when we are making our retirement withdrawals. We certainly know this from the 2000s decade that had the three bear markets versus the 2010 decade, which had a strong bull market. So we know that decades are different, years are different, time frames are different. Now, we can say, yeah, but we would have had bonds in our portfolio to offset the years that stocks went down during that time frame, or in our time frame if we're a stock and bond investor. Well, that works sometimes and it doesn't work sometimes. It depends on the interest rate cycle as well as other factors. I've done another video about the false correlation or lack of correlation between stocks and bonds. Stocks and bonds don't always move in opposite directions. In fact, historically, they have moved together more than they've moved apart in the past century. So make sure you check out that video for more about whether or not your bonds will go up in price when stocks go down. As a matter of fact, the S&P 500 index, which represents 500 stocks in the U.S., went down from roughly 1965 until 1992. Yikes, that's a really, really long time frame. So I referenced the 2000 decade followed by the 2010 decade, and we're sort of looking at 10-year periods there, and you can go, yeah, but those were decades, they sort of averaged each other out and you came out ahead. Well, we also have been through really, really long periods where stocks were not doing anything, and that could happen during the time frame in which you're retired. Can you rely on bonds to work for you during then? I'm not really sure, since we've recently ended a very long-term 40-year interest rate cycle. I'm not comfortable relying on bonds to pay my bills for the rest of my life. Okay, so, and I don't know if I mentioned or not, but I will throw out 3 solutions at the end of this video, so make sure you stay tuned. All right, so the next thing I want to mention is that was the S&P 500. The S&P 500 was invented in 1957. So this led me to go look to see how the Dow Jones Industrial Average, that index, has done from a longer time frame, because I knew it had been around longer than the S&P 500. And sure enough, it had similar non-performance years in addition to the period like the S&P 500 had. It also had a period of non-performance from 1929 to 1961. It sort of did nothing. Now, this is based on charts. I'm throwing them up on the video so that you can see that yourself. Factor number 2, or big concern number 2 with retirement income planning using the 4% rule. And that is the sequence of returns risk. You've heard me talk about this a little bit here before, but that simply means that if your investment account has negative returns in the years shortly after you retire, then that strongly affects whether or not your retirement withdrawal plan will hold up for the years that you were hoping that it would hold up. It sort of blows your plan. Now, I've put together some charts that you can see here from my website, retirecertain.com. All right, so on these charts, I am showing you Miss Opportunity and Mr. Faro. Mr. Faro is what I like to call fixed asset allocation regardless of risk and opportunities. And Miss Opportunity is investing based on opportunities at any given time versus, that fixed buy and hold no matter what happens. Okay, so what happened though is that Miss Opportunity only had one minor negative investment return in the first 10 years of retirement. And she had over $2.5 million left at the age of 90 in her retirement savings. Mr. Faro, on the other hand, had double-digit negative returns in 4 of the 10 years of retirement. He ran out of money at age 83. Now, you may be thinking that it's very unlikely that this would have happened, but this could have easily happened with a stock market investor in the 2000s decade. In fact, even a stock and bond investor would not have fared that great in that decade. sequence of returns risk are really problematic with people that are living off of their investments, making those retirement withdrawals, as so many retirees are doing or planning on doing. So the problem is that they're withdrawing money during those lost years. Not only this, it's particularly problematic during times of inflation. So what can an investor do about this? Well, investors can consider what is the likelihood of a bear market happening during the next few years. And while none of us know what's going to happen, and it's always a surprise, we can look at valuations and other factors to say, what is the likelihood? Is it more likely the market is going to go down from here or up from here over the next few years? And this is very well published information, and it's something that investors can do who are simply paying attention and making investment decisions based on factors that are available to us. My third major concern with using the 4% rule for retirement income planning is that it's emotionally taxing to spend your money, especially during bear markets and or recessions and or rising inflation. It feels bad. It feels wrong. We've worked our whole lives to save money and put it aside, and unless we're really, really sure that we've exceeded the amount of money we need to live for the rest of our lives, it just doesn't feel good to make withdrawals, whether that's 4% or 5% or 3%. But this is problematic with that whole plan of making a withdrawal based on, in this example, the 4% rule. My next concern about using the 4% rule for retirement income planning is that the 4% rule was based on a stock and bond portfolio, period. Now investors have access to so many other assets that are defensive assets that can enhance a portfolio's performance, particularly if they're not bought and held forever. In that case, they can actually drain a portfolio's performance a little bit, because when you hold something that's very defensive, it is a drain on the returns of assets that aren't defensive, that do really, really well during rising stock markets, for example, which is the period we're usually in. But the problem, the 4% rule, is based on that stock and bond data. So I don't know about you, but I really, really like to use data in my investment decisions. I know it's going to be different than it was in the past, but I want to look and see, what has this investment strategy or this fund or this product or advisor or professional done in the past based on these various time frames. I like looking at data. Math doesn't lie. It's there, period. And the comfort of the 4% rule comes from knowing this is a good, great piece of research that so many people are counting on. But now investors invest in so many other things, or can invest in so many other things besides just stocks and bonds. What about gold? What about real estate? What about other commodities? So will an investor not invest in these other asset classes because they're planning on using that 4% rule and there's safety in that? Or will they say, I'm going to invest in these other asset classes because they make sense for me now to invest in these? So I find that it's somewhat limited. Portfolios that only invest in stocks and bonds are limited. It no longer works for me personally. And I know this is the case with more and more investors as we have the option to invest in other asset classes that were once impossible or very hard to invest in, such as gold. The fifth concern that I have about retirement income planning based on the 4% rule is that the rules have changed. My great uncle Blake retired when he was 65. That's when everybody retired. And he left the Standard Oil Company with his little pension, and he lived maybe another 10 years. He didn't live that long in retirement. That's how it used to work. Now people are living longer. Some people are taking an early retirement, so they're having to make those retirement withdrawals longer than 30 years. And this concerns me because I'm not 100% sure that everyone is realizing this based on what I'm seeing in the comments I'm getting. And so people are living longer in retirement than they were when the study was done, the 30-year time frame. So of course you know that, and you can make adjustments for that. There's the opposite end of this is that someone may not retire until they're 70 or 75, or they may not need to make withdrawals for 30 years and they don't really enjoy their life because they're too afraid to spend their money. So this can go either way. So what's the answer? What do you do about these concerns? Okay, well, I've got 3 suggestions. The very first one is throw out the cookie cutter rules. I hate cookie cutter rules. We all love them, right? They make life easy. And you've probably heard me say this before, but we're all so different. We're all so different in how much money we have, how much money we spend, and we're all different in our lifestyle desires and what we want out of our lives. How much time do we want to spend investing? Do we like investing? Is it stimulating? Do you enjoy it like I do? Or do you just detest it and you want to avoid it at all costs? All right, which is another topic. But the point is, forget the cookie cutter rule. Everybody has to look and see where they are and does this work for them? Okay, so that's number 1. The second one is if there's any doubt whatsoever that you have enough money to sustain your standard of living in retirement, go ahead and establish another income stream. It's so easy to do now. We can see this. The millennials have done a great job of this, and younger generations as well, in finding new creative ways to create income streams. It can be done with low capital or no capital strategies, as well as high capital strategies. So think about what you can do to create some sort of income stream. Gosh, this is so broad. It can be anything from consulting to, part-time employment, to selling covered calls on income dividend paying stocks, to rental property, to online business. There's so many different things that you can do now to create another income stream. So that's number 2, is the more income you have, the less money you need to save, first of all, because you've got that income coming in to reduce the amount that you need to withdraw. So the amount or the difference that this can make is huge. Okay, then the third solution is to simply learn ways to improve your investment returns. Okay. This can often be done simply by cutting fees. I've worked with coaching clients where we cut the fees by 1% immediately. Well, that just goes right into your account. It stays in your account rather. And you can look and see, can I do that? Can I lower my investment fees? This could be with your 401k. It could be if you work with a financial advisor. It could be funds. Can you go into lower cost funds that would get similar results? How does the fund you're in compare to the index fund, which you can own for nothing and often get similar, if not better, returns? See if you can lower your investment fees. It doesn't take much effort to do that. Beyond that, look at different ways that you can invest better. I like to say that we need to make demands of our money, of our investments, just like we would if we bought a house. We want this or that. We want, a kitchen big enough to entertain, or a front porch that we can enjoy in the summer. We have these specific things that we want from the use of our money. Investing is the same. We're buying assets. We're simply purchasing something, and we can make demands of what we want as far as what we get in return for that use of our money that we're giving up. So I like to urge everyone to have demands that you make of your money instead of feeling like you just have to settle for whatever's out there, whatever available, because there are ways you can improve your investment returns. And remember, retire certain.